According to Peter Lynch, the general public is aware that there is an unbreakable link between the performance of a company's stock and its earnings over a period of several years. If McDonald's has performed exceptionally well as a business, then the stock has also performed quite well. People are concerned about the availability of too much money. What has happened to the price of oil, who is the president, and who is being nominated by the Supreme Court. However, the ozone layer has nothing to do with McDonald's earnings going up over the next 10 years and the stock will go down. He is unable to forecast what the premiums for long-term insurance will be in 1 year, 2 years, or 3 years from now. In fact, he is even shocked by how cheap they are right now. The current chairman of the Federal Reserve, Alan Greenspan, is unable to make accurate projections regarding future interest rates. Although he might be the first person to be able to sway someone else's opinion, he is unable to forecast changes in interest rates. The main argument that Peter Lynch is trying to make is that yes, macroeconomics is significant, and yes, it does affect pricing. Nevertheless, from the perspective of an investor, it is one of those things that are short-term, and you have no control over it. Why waste your time worrying about something that you can neither forecast nor control if you are unable to do either of those things? This is a mistake that many investors have made this year, and to be fair, it is understandable why they would make such a mistake, since virtually every news outlet has been covering it non-stop recently. However, as an investor, you must avoid getting distracted by matters of this nature and instead keep your attention hyper-focused on the prospective investments you are considering making and evaluate each opportunity on its own merits. He stated that stocks are not the same thing as lottery tickets and that there is a company behind each stock. If the company is successful, then the stock is successful as well. It's not that complicated, but some people let it make them feel overwhelmed. They try to anticipate interest rates, but no one can predict the stock market. If someone could predict interest rates correctly 3 years in a row, they would be worth $1 billion. Without a doubt, it is. There are not that many people in the world who have earned $1 billion. There couldn't be so many people who can accurately estimate interest rates because there would be a lot of billionaires and no one could do that. It is a famous quote from Peter Lynch, but it really drives home the point that although macroeconomics is what sort of makes the world go around, it's actually not what long-term value investors should be concentrating on. For instance, the last time interest rates were higher than they are right now was in 2007. But just think if you didn't acquire a business like Amazon, Apple, or Google just because you were afraid of interest rates. Even now, with the market being down, there will still be a lot of investors selling off their portfolios out of fear that interest rates could go much higher and stocks could suffer as a result of this fear. This decision was obviously a bad one in hindsight, but even today, with the market being down, there will still be a lot of investors doing this. According to Peter Lynch, the thing that we should really be concentrating on is paying attention to the earnings of each particular company. Therefore, we shouldn't be concentrating on the big picture. But what should we do now that the market has dropped 15 points? Should we wait it out and see what happens? Or should we buy lower price stocks? That seems to be the tale of the last several years, doesn't it? The market was literally tearing itself apart despite the fact that interest rates were at zero. However, we are currently observing the complete opposite. Both interest rates and the stock market are trending downwards. But Lynch's main argument is that there is no reason for you to be anxious about this situation. When the market is hot and you do your discounted cash flow analysis, then typical conclusion you come to is that the stock has to execute perfectly over the next 5 years in order to actually justify its current valuation. On the other side, when the market is falling, things begin to swing in favor of long-term value investors. This is because the market tends to correct itself over time, and that is probably the most important thing for you to keep in mind while the market is falling. It is imperative that we maintain our attention in the long term. In the following 2 years, nobody can predict what will happen. In the next 2 years, the stock market could go up or it could go down, and there is no way to know which way it's headed. However, over the course of the following 10, 20, or 30 years, the likely outcome becomes much more evident. When companies improve their productivity, they either increase their earnings or their valuations, which causes an increase in the price of their shares. Lynch said that we can pull out a coin and flip it. He said that he doesn't know what will happen with the next 1,000 points. 20 years ago, there was no Microsoft. 20 years ago, there was no Staples. 20 years ago, there was no Federal Express. 20 years ago, new businesses will start up. What makes this country work is when new businesses start up. So that's the game. We should keep our eyes on the long term and keep an eye out for solid-looking companies that pop up on our radar. The ones you understand, the ones that have a competitive advantage, the ones with really well-oiled management teams, and most importantly, the ones that offer a steep discount to intrinsic value. And this has been the problem over the past few years. There have been a lot of great businesses out there, but all of them have been priced so high that they would have to run perfectly for the next 10 years for their prices to make sense. Peter Lynch is optimistic about the long-term prospects of this company's financial performance. If it is already for sale, this is an indication that it is being offered at an extremely steep price. It is necessary that it be successful, and if it is, nothing will change about the situation. Therefore, it is up to you to determine for yourself whether or not he is accurate in estimating the amount of money he will make. The risk-to-reward ratio indicates how much more he stands to lose if his prediction of how much he will lose turns out to be incorrect. We discuss how, in the stock shot, he intends to double his money if he is right. But if he is wrong, he can lose 30 to 40% of his money. This is because he is betting on the outcome of an event that strikes the right balance. If you share his viewpoint, the price of the stock won't improve. Already, it is stripping away many wonderful things. That really will be the key to making good investments in 2023. If you keep an eye on these valuations, you know that we're looking for our great companies that are priced low enough that the risk-reward ratio is in our favor. For example, if you think that a stock will grow at a rate of say 15% per year for the next 10 years, and if that happens, you think that each share is worth $50 right now, you may not want to buy it. Well, if the stock stays at 50, that's not a great place to be. If you buy shares, the company has to do everything right for you to get your money back. What we want to find are the stocks that you think are worth $50 today but are actually selling for $25. Peter Lynch was saying this. Long story short, we find great companies that are priced way below what they're really worth, and we take advantage of this market weakness. Here is the public company he likes the most out of all the ones out there. The basics are great, their profits are good, and their competitors are doing badly. He thinks this company is doing great, but because of this drop, the stock might have gone from $40 to $30. Here is an opportunity to buy. It's so you can see that some companies may have been overpriced at 60, and all they did to fix that was drop the price to 50 and say, so what? So we should look for businesses that are being sold. The ones you know were fairly priced, but now that the market as a whole has moved, their prices have gone down to a safe level. We don't get too caught up in the details of macroeconomics because we don't want to be scared away from our tried and true long-term value investing strategies. Well, I think that covers everything for now, folks. We appreciate your time and attention. Of course, if you like this video and want to see more from the channel, you can show your appreciation by clicking the like button. We'll wrap up here for now. Stay tuned for more videos.